A short history of Swiss investment banking. The history of investment banks in Switzerland goes back several centuries and has seen the rise and fall of major names that have shaped the country's financial landscape and significantly contributed to the economy. UBS, SBC, and Credit Suisse over the years. Union Bank of Switzerland traces its roots back to the early 19th century when it was founded as a bank specializing in financing the Swiss railway system. Over the years, it expanded its operations, establishing itself as one of the country's leading banks, opening offices worldwide and attracting customers from abroad, a move that would position Switzerland at the core of global high-net-worth private banking. Swiss Bank Corporation has its origins in the mid-19th century and grew through mergers and acquisitions, but also by the fast adoption of key technology and the hiring of prominent figures, all at the time when the equity derivatives market was booming across Western exchanges. Credit Suisse was founded in 1856 as the first Swiss bank exclusively focused on investment banking and foreign trade, with a later presence in the U.S., obtained by a renowned acquisition, that went under the name of Credit Suisse First Boston, a primary player in the rich IPOs market of the early 2000s. Evolution into fully fledged investment banks in the 20th century. During the 20th century, these three banks expanded their investment banking activities, significantly fueled by an inflow of money from abroad and by the great stability Switzerland guaranteed to its financial system. They ventured into capital markets, mergers and acquisitions, and trading, serving clients worldwide, but also acting more and more into roles like arrangers, global coordinators and bookrunners. Throughout the 90s, seeking to become a top 10 name in investment banking, SBC embarked on a huge acquisition plan that culminated with the purchases of the US-based Dillon Read and the historical British firm S.G. Warburg. This ultimately led the bank to change its London arm name into SBC Warburg Dillon Read. UBS Derivatives Department and the collapse of the bank. In the late 1990s, UBS experienced significant growth in its derivatives department, particularly in its New York office, mostly led by a team of quantitative professionals who were very experienced in the theory of pricing and hedging both European and American options. However, this expansion was accompanied by an increase in risk-taking and inadequate risk management, and in 1997, because of a glitch in pricing algorithms, the equity derivatives desk had acquired losses for several hundred millions, losses that led to the resignation of the head of the department along with several traders, putting UBS on the edge of bankruptcy. The first big merger. In December 1997, UBS and SBC announced their intention to merge, formally justifying the move as a way to reduce costs and to optimize structure, while it was in fact a bailout of UBS by SBC. For unclear reasons, however, the new bank adopted the name UBS, rather than that of the buyer SBC, but maintained the historical notorious three-key logo, that seems to have inspired Swiss bankers across the decades. Rise and fall of Credit Suisse. Over the last decade, Credit Suisse began facing various challenges, while it had rather managed to navigate through several crises of the past. It struggled with its investment banking division and faced legal and regulatory issues related to tax evasion and improper market practices. Despite attempts at restructuring, the bank incurred significant financial setbacks and lost public trust, while becoming the target of several inquiries in the United States and Europe. The second big merger. After almost 2 years of talks, and amid a prolonged situation of deteriorating assets, Credit Suisse and UBS finally completed their merger in June 2023, a move that took place under the silent but determinate blessing of the government. The deal, while reassuring the Swiss public, as well as foreign investors, was interpreted by many as the last act of a constantly eroding Swiss banking landscape, whose active entities contracted over the decades from 3 to 2, and then from 2 to 1. Shrinking banking industry and decline in Switzerland's financial status. Switzerland's banking industry has indeed experienced significant contraction due to various factors, including increased regulations, global economic trends, foreign influence, and even technological advancements. This has led to a decline in the country's financial status on a global scale, a trend that is also well mirrored in the positions the Swiss stock market keeps losing in global rankings. Potential impact of a would-be collapse of UBS. It is no doubt the Swiss government is well aware of the problem, as a hypothetical future collapse, or even the mere distress, of UBS would undoubtedly have irreversible consequences on the Switzerland's banking industry, and trigger chaos on its overall economy more in general. It could lead to a loss of confidence in the country's financial system, extending to the remaining smaller banks, potentially causing a butterfly effect onto the entire nation. For some reason, the country that has so much benefited from its geopolitical independence, and from its one-of-a-kind banking system, has now become the target of multiple outside entities, who have identified in Swiss banking a sort of nefarious artifact. The Bank for International Settlements in Basel, although not strictly a Swiss entity, is also said to be advising the government on a long-term plan to restructure Swiss banking over the next decades, but it is highly unclear whether bankers and regulators will find or not the proper way forward. With the rise of new Asian banking giants, in a matter of years, both Swiss and European legislators might discover that the tight regulations they have adopted over the decades are in fact the boomerang they should have never thrown.